Hi everyone, in the presentation I'll be talking about can tech avoidance help economic growth. I have divided my presentation into four parts. First, I would like to give you an introduction. Second, I'll move to the literature. Third, we focus on data and methodology. And finally, we will talking about conclusion and suggestion.
Introduction part. All citizens have to pay tax to government, but many taxpayers try to avoid as much as possible, lead to the decrease in tax revenue. Many countries have failed to raise the government revenue because of tax avoidance. How can we measure tax avoidance? The close relationship between tax expenditure and tax avoidance. Non-transparency of tax expenditure itself is a loophole to tax avoidance. A large amount of tax expenditure is somehow caused by operate firm and taxpayer of non-transparency behavior.
Tax avoidance is the process by which an individual plans the finances to apply all exemption and deduction provided by tax laws to reduce taxable incomes. Through tax avoidance, an individual take advantage of all legal opportunities to minimize their state or federal income tax, gift tax, or estate tax. An individual may, for example, avoid federal income tax by investing a large sum of money in municipal bonds, since the interest on such bond is not considered to be taxable income on which federal tax is due. Interest on the same amount of money placed in the saving account must be included as taxable income. Information about the size of the avoidance gap comes from on a list of the tax expenditures published by the Office of Management and Budget and the Joint Committee on Taxation. Tax expenditures are defined as revenue losses attributable to provision of the federal tax laws, which allow spatial exclusion, exemption, or deduction from the gross income, or which provided a spatial credit, a differential rate of tax, or a deferral of liabilities.
Now, let's look at an example of tax avoidance.
Welcome to Big Biz Co., a fictitious multinational based in the US. Big Biz has a presence in dozens of countries, including the UK, where it makes widgets. Its British subsidiary, Big Biz UK, made widgets last year that sold for £900 million. But corporation tax isn't paid on sales, it's paid on profits. Somehow, Big Biz UK only made a profit of £10 million. How? Well, because Big Biz UK spends a lot of money importing parts from Big Biz Hong Kong, and every widget it makes it then sells on very cheaply to Big Biz Ireland, which has rights to sell the company's products across Europe. Big Biz Ireland charges more when it sells to consumers and does earn a healthy return. End result, Big Biz makes most of its profits in low-tax Ireland and Hong Kong, not the UK. And it doesn't even pay Irish tax on most of those profits because Big Biz Ireland is run from New York, so the Irish authorities say it's American. The US, meanwhile, treats the company as Irish because its business is overseas. Magic. And all those low tax bills are perfectly legal because most of the rules were written nearly 100 years ago when the world was very different.
Annex Literature Reviews. Macquarie used three-step square method in 23 states were selected for analysis. The source is the amount governments have spent on the tax expenditures has no impact on true economic growth or agricultural products. Annex study used the BGP equilibrium for generating the graph. The source is tax avoidance can either increase or reduce economic growth depending on the values of the nominal tax rate and on the avoidance incentives, and found that the impacts of avoidance on the welfare products by change in the normal tax rate is quite large. Annex study compared the data of revenue loss in Nigerian customs service from 2004 to 2006. The source is reductions in tax expenditures could simplify the income tax and makes it less prone to abuse. The next study, from 2013, He used growth regression equations derived from solo SRAM models, using data from 13 countries, which cover the period from 1965 to 2009. He found the significant and negative effect of growth in total populations and positive effect of growth in working age populations on economic growth. And the last study, they used OLS in 36 years from 1974 to 2009 indicates strong positive impacts of human capital on economic growth.
For data and methodology, we find the answer by using OLS method to estimate economic growth that caused by human capital, demographic change, tax rate, and tax expenditure. According to the research we mentioned in previous section, tax rate and human capital are positive, tax expenditure and demographic change are negative. The variables come from World Bank and the Pew Charitable Trust. Economic growth represents gross domestic product. Tax is average nominal tax rate. Tax expenditure represents tax avoidance. Human capital comes from level of education by average 15 years. And demographic change comes from population growth.
An independent variable, tax variable, is nominal tax rate. Tax avoidance may be positive for growth when a tax rate takes sufficiently high values, according to the results of Fair, Seren, and Mahdi. And they found growth maximizing tax rates crucially depend on the intensity of avoidance, so nominal tax rate has positive effect on growth rate. TE variable is tax expenditure, which we use the amount of tax expenditure to see how large of gap of tax avoidance. In Sector 2 of this paper, we show a lot of study of the impact of tax avoidance and tax expenditure on economic growth or government budget. The result of each paper is not the same, but we expect that the negatively impact of the tax avoidance on economic growth. HK variable is human capital. A level of education by an average 15 years, labor skills had an important role in economic growth. Developed countries seem to have labor skills more than developing countries. In 2014, United States had GDP per capita about 54,000 US dollar, while GDP per capita of Vietnam is only 2,000 US dollar. Archer, Alwan, and Raymond show the results indicate strong positive impact of human capital on economic growth despite the fact that Pakistan has been spending less percentage of GDP. The expected side we expected is the positive. DEC variable is demographic change. Many studies have found the significant relation between demographic change and economic growth. The Solos 1 model indicates a negative impact of population on economic growth at steady state. So we expect the side of demographic change variable to be negative.
Conclusion: as a tax avoidance happened by an incentive of deduction tax burden, this paper's objective is to answer the question whether tax avoidance can help economic growth. We try to find out the effect of tax avoidance by using tax expenditure. The gap of tax avoidance, the larger of tax expenditure, the larger of tax avoidance, and the lower of the government revenue. We have expected the negatively impact of tax expenditure on economic growth, while the other variables, tax rates and demographic changes, had the same effect as tax expenditure. Human capital, we expected to have a positively effect on economic growth, even though we do not collect the data and run the regression for the result. We cited from many earlier studies about the effect on economic growth to assure the impact of tax avoidance on economic growth. Suggestion: even this paper has assumed tax avoidance by using tax expenditure and the result by the other study show the negatively effect of tax expenditure on economic growth. One thing that is not quite clear in this paper is that what will happen if government decide to cut out of tax expenditure out of the system. As for the effect of wholesale elimination of tax expenditure on tax avoidance, we believe that is a more open question. Eliminating large number of tax expenditure would reduce the avenue available for tax avoidance. That is, hiding income from tax collector would be much more difficult if all or most of the explicit tax loophole were eliminated. We suggest the further study to show the difference of economy with and without tax expenditure. Even tax expenditure may worsen the economic growth, but without tax expenditure, the economic growth may be worsened off. Please feel free to ask us your question or comment below. Thank you for your attention.